From the morning reading, oil rallies, SPX moves higher, MMM, J&J, PG, and DD positive earnings per share. Reactions lift the Dow Jones Industrial Average. Apple lower in after hours. All 9 sectors moved higher on Tuesday. XLE, XLI, and XLB were the strongest sectors, while XLU was the weakest sector. Oil gained 71 cents to close at $30.51, fueling XLE as the strongest sector. Breadth strengthened as advancers led decliners 5.06 to 1 on the New York Stock Exchange and 2.40 to 1 on the NASDAQ. Let's see here. I think that's enough in the morning reading for today. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:44 a.m. Central Time, and I'm recording this in preparation for the market day of January the 27th, 2016. Remember that on YouTube, you can have a free subscription to the channel and be alerted to the new content being published. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high definition playback level. In the same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5 times the recorded speed. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And generally weak in the overnight on all 4 of the U.S. broad market indices. The S&P futures are down some 12 points, about 2/3%. Russell futures down almost a full percent. NASDAQ futures are also down right at 1%. Dow futures are down about 0.38%. Crude oil, again, lots of volatility here, down over $1 or over 3.2%. Euros up about 0.2. Bonds are essentially scratch, and gold is down about 1/3%. In terms of overseas action, China down about 0.5%, Hong Kong up about 1%, Japan up almost 3%, Germany down almost 1%, United Kingdom down over 0.5%. In terms of macroeconomic reports for today in the United States, you have the FOMC statement and the Fed funds rate announcement late this afternoon, so be aware of that. That could absolutely change the market dynamic for today. Earlier today, you do have the new home sales. And likely what you'll see is that the markets will go flat heading into the FOMC statement, and then an explosion of volatility is always possible. In terms of tomorrow and looking ahead, we have the weekly version of the unemployment claims. We have core durable goods orders, pending home sales, and then for those that trade natural gas futures, the nat gas storage report is also tomorrow. In terms of current volatility, we've been all over the place, but in general, short-term VIX has been coming down a little bit. We're down below 25 now. IV percentile for the S&P is 47, Russell 43, the NASDAQ 45, and the Dow 43. Standard deviation moves were put on 3 of the 4 indices yesterday. So we certainly have had price volatility coming back. In fact, we'll go ahead and go to the charts now, take a look at that. And here's the SPX and the recent range and the undercut of the double bottom reversal. And then we've had this collection of 3 large body candles. And I think the best way to think of this is think of it as one candle where you start here and you end here. And that, in essence, is the result of the price action of the last 3 days. So while certainly a lot of volatility just to end up kind of back where it was 2 closes prior, the net effect is from here to here. As such, with yesterday's close, we did close above the 10 EMA. And that's important because that's one of the criteria to be able to move to the market phase level 2. We're currently still phase 1, And part of the reason for that is that we want to see a green candle above resistance. And you notice that our near resistance would be defined as this area right here. And we want to see the closing price above the open of the breakout day. So I would call this the breakout of the diagonal. This candle here would be the close of the breakout day. So we need to see some action up in here, above here, and with a close also above this breakout area to kind of move us into phase two. So we're very, very close to being able to change our market phase opinion there. So some important things on the SPX chart. In terms of the Dow, very similar action. NASDAQ not as strong, and of course Apple is going to affect whatever the Dow and the NASDAQ do today. And then let's go to the RUT, which is our Russell. Very similar price action to the S&P of late, though from a setting that is much, much weaker. But off the reversal bottom, the break of the diagonal resistance, and then this cluster of three large body candles coming in, setting up for a potential to break up. Now we also, in terms of volatility, and this concludes today, we have, in general, a short-term downward trend. Though keep in mind, the Fed today has the potential to inflect this, as well as some key earnings reports, and I mentioned several of them, 3M, J&J, Procter & Gamble, and others that are significant players and could be an influence on the market direction today. In fact, this whole week is a huge week for earnings. So that could have a play on this, as well as the Fed's announcement could have a play on this and could inflect this in either direction. But thus far, the trend is towards increasing bullishness, towards increasing health, increasing intermediate term bullish potential. We're not quite there yet. And then also that we might have volatility continue to come down. Now, all that could be washed aside in one fell swoop, and we could roll over and see this market return to the bottoms with a big bear flag rollover and failure back for towards the bearish side and against the bulls. So a lot of potentials there, but the point is that we're something of a really important area here, and we have some important news coming into the market, which will likely dictate just which way this actually breaks. And we've had the criteria come together to be able to establish something of a capitulation bottom and a reversal on this most recent weak action that took us a whole bunch of points, basically 2075 down to the 1800, so about 175 points. We have had the criteria come together to say this may be a intermediate term bottom, and that the price action would expect to reverse and come back up into this area. I'm still very suspicious of this and thinking that we could have another rollover, but at the same time, the charts are saying that this right now is a bottom and things are improving. So we certainly have to be cognizant of that and give that a certain amount of respect, while at the same time, we can certainly be watching for signs of a rollover. And indeed, you'll see a number of things on the daily report that have changed in the most recent days. We're still phase one, as I said, not quite hitting all the criteria to get to phase two, but certainly getting very close. In phase one, we expect bear flag reversals. We expect to kind of have a fat toe in the water, be probably selling things like out-of-the-money puts or using reduced stock positions to kind of scale in a very cautious and defensive manner. We do have a change in the portfolio investor posture. With IBD has gone to confirmed uptrend. Accumulation distribution, though, on the S&P chart is still an awful E, as well as the NASDAQ, also that awful E. GMI index is not elevated. It's still 0 out of 6 on a sell signal, and has been that way since 1210. That authored very happily in 100% cash. Also check the stock charts decision point yesterday, and no changes here. We still have on those systems, those mechanical systems, down or bearish arrows on the short term at best, neutral signals, and indeed even the intermediate and for most of the long term still all quite bearish. So when you put the consensus of all this together, we go back to our description of market in transition, waiting to see whether this breaks up or breaks down. And until we actually see some sort of confirmation and resolution of that, we're still just kind of this wide range, a very wide range given, but still a wide range in a market in transition and a market that is capable of going either direction. In terms of the intermediate term market posture, it is currently second day bullish, but it also has some poor candlestick patterns to, we don't particularly like to see this three large body cluster where you've got one big up, one big down, nullifying the first, and then another big up just to come back. And then, of course, in the overnight, we've now had, pretty significant weakness, currently down about 8.5 points as I speak right now. So it's a very, very, very choppy pattern. That's what can happen when you get high volatility and a range-bound market, which is largely what we're in right now. And until we get some resolution, we're likely to see more of the same. In terms of position sizing opinions, we've had changes here as well. When the IBD status went to confirmed uptrend, that took the buy alongside portfolio exposure mechanical signal to 100%, though I would suggest to continue to be very defensive until we get some improving indications that a bottom is truly in and not just a bear flag. We've had some positive signals, but there's still an awful lot to be worried about. There was a significant amount of technical damage done to the charts that created the current situation. In terms of volatility, position sizing, that one's also improved slightly and is now in the 50 to 75%. So kind of keep that in mind. We have to respect that we're seeing some improvement in these signals, and yet at the same time, there's others that you're going to see that are still quite negative. In terms of that intermediate term market posture, all four markets are now signaling bullish intermediate term market posture, so we have to respect that as well. Now, when you just get up over 20, that doesn't mean you load the boat. It means you start sticking that fat toe in the water, selling out of the money puts, putting on partial positions of stock, perhaps initiating some vertical spreads and stuff like that. At the same time, not getting overly excited because the market doesn't certainly represent that quite yet. Hedge warning status has been reduced to 1+, which is our yellow light. Think of it as yellow light. When you see the car in front of you hitting the brake lights and that turn signal or that traffic light turning yellow, you're preparing to stop if you must. And that's kind of the condition that we're in. So you might be able to proceed, but you might also need to come to a very, very quick stop. And that's a very good description, I think, a very good analogy of where the market posture and hedge warning status is at this point. In terms of short-term risk, it's actually fairly risky right now at a 7 on a scale of 1 to 10. Medium-term risk, relatively benign at a 4. In terms of special metrics, market in decline, sharp increase warning are still present. VIX futures still up over 18. That is not the land of the bulls. It's the land of the bears often. Distribution day count has been reset as we've come out of this market in correction and gone to confirmed uptrend. We do have VIX phase has been falling of recent, skew just barely in warning status, up over 125, so running about a 9% probability of a 2 standard deviation move in the next 30 days. Current week out is also still elevated. It's not as high as it's been, but still at 60 plus. is about 1.5 times perhaps about typical for recent weeks. In terms of the new highs, new lows, relatively benign there, nothing of interest. The intermarket risk aversion indicators continues to see slow but steady progress towards improvement. We now have 2 as flagged as risk on against 3 as risk off. In terms of the fear and greed index, it's a 17 again. Some improvement here. If you think about, say a week ago it was 11, then yesterday was a 15, now a 17. So continued improvement here. In terms of special opinions, there's some changes here as well. In terms of option income strategies, the VIX is outside the acceptable window to initiate new positions for novice traders. With the reduced hedge risk level, you may find that aggressive traders might welcome the increased premium that can be received from higher volatility, knowing that they are ready and have the capital and the skills and experience to be able to handle what could be higher, larger delta and vega moves and be able to make those adjustments. In terms of covered calls and put selling, conditions are borderline acceptable to initiate new positions for novice traders. More aggressive traders will certainly also find that using some of these defensive steps that I mentioned here, and indeed you might want to consider 1/3 position size. You might want to consider using only in-the-money strikes. You might also want to consider using lower beta positions as you start to kind of stick that fat toe in the water and then wait for the market to prove itself that it is actually following through. We've had with this most recent confirmed uptrend, since I've been following that system, and in the last 13 months, we've had 13, get that, 13 confirmed uptrends. The previous 12 have all failed. Now, I'm a huge fan of IBD. I like their system, but it's a reflection of what the market has been doing. It's been largely a range-bound market, and much like any other crossover system, think of it much like a moving average crossover system. If the market is flat, you get lots of false signals on both sides, and that's probably very much what's happening with the IBD signal of late. Many of those confirmed uptrends lasted literally just a handful of days before they rolled over and went back into market and correction. So it's been very difficult to gain any ground, and I remind you of that as you consider the legging in to some new positions in both cover calls and in put selling. Certainly you want to keep puts in the position size that you are willing to own, because you could end up owning that position should the market roll down into marketing correction. And given the kind of price action we've had, it's always possible that we find that the most recent swing bottom doesn't hold, at which point we could go from being down 15% and in a full-fledged correction into a full-fledged bear market and start to look at the face of being down 20 or 25%. So there's a potential here, and that's why the hedge risk level is still somewhat elevated at a 1+ in the face of some improving conditions. So I think that's probably enough for today. Oh, let's take a quick look down here at sector specific. This doesn't look like it got updated for some reason. So we'll go ahead and wrap up this for today. Let's see here, a couple things I'll mention. Well, let's go to, and I'm flipping through these. You can hit your pause button, and if you want to see something closer, just get the hyperlink there and go to that. I'm going to say last chance to be able to get in on the Cover Call Mastery course, which starts on Saturday. We've got just a couple days left here in which you could get a registration in and still participate in everything. This is a very comprehensive mastery course to develop a complete rules-based cover call trading strategy. If you've ever wanted to become better at your stock screening, at your understanding of fundamental and technical analysis, at the rules-based approach to trading. Certainly this course will do that for you. Also, I would mention that if you've ever wanted an introduction to options, the covered call is the classic introduction to options. And indeed, doing a covered call actually is less risk than owning the stock by itself. If you own 100 shares of Apple versus having 100 shares of Apple in a covered call, the one with the covered call is actually the one with the lower cost basis and less risk. So you can generally do covered calls in IRA accounts. That tells you just how structured that trade is, and many of the brokers will allow you to do covered calls with permissions in an IRA account. So additional details, just go to the hyperlink down here at the bottom. If you choose to register, send me an email to Stephen@FalconGlobalTraders.com. We have a great group put together already. We're looking forward to the beginning of the class on Saturday. If you thought you want in, now's the time to push that forward and get off the fence and jump into that class. Let me get those textbooks ordered for you and let you participate in that process. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Hyperlink at the bottom for the full disclaimers. And that should take care of it for today. We'll look forward to seeing you back here tomorrow morning for the Falcon Global Market Preview. Good trading.